Hello, everyone. My name is Fred Kaplan, and I'm here to talk this afternoon about the truth behind business valuations. A little bit about me and our firm. I'm a certified mergers and acquisitions professional. Stony Hill Advisors is a firm of 10 partners. We provide M&A advisory, business valuations, and exit value planning for business owners where an exit is not imminent, but in the future and want to plan ahead to maximize the transferable value of their business at such future date that they're going to exit. We've been doing this for over a dozen years and have clients nationwide. I lead our food and beverage practice, working with a number of breweries, having sold them and currently selling 2 breweries at the present time. Our work as sell-side advisors and buy-side advisors essentially is a project manager. We manage the project of selling the business, or on the buy side, the project of acquiring a business, so the business owner can stay focused on running the business, which is the most important thing. We're going to talk about 4 things today. Go over some terminology as a foundation, dispel some myths that you may have heard from colleagues or friends, go over what are the valuation methodologies that are used, and then what is a process that you could expect to go through if you are going through a valuation. So the first thing I'd like to talk about is terminology. MVIC, or market value of invested capital, is really the same thing as the selling price. It's all the capital that the total consideration paid to the seller. Net sales is just that, gross sales less returns. Gross profit is sales less your cost of goods sold. EBITDA, a term that hopefully many of you know, earnings before interest, taxes, depreciation, and amortization. Essentially, it's cash flow from operations. And seller discretionary earnings, which is not as commonly used, but very important in the valuation practice, because professional valuation analysts will add owner compensation and related benefits back to reported EBITDA to create the seller discretionary earnings figure. This is done because the owner of a privately held company has discretion over whether to leave profit or to reinvest in the company or take it as compensation. This SDE, as it's known, represents the free cash flow that a buyer would receive with discretion to spend on compensation or reinvestment in the business. Here's a traditional income statement calculation of net income, EBITDA, where we add back the non-cash expenses to approximate cash flow, and SDE, the free cash flow to the owner. So you can see here that we have operating expense of 40 units, of which 10 represent the owner's compensation, and we add that 10 back to EBITDA, and so we have 40 units of SDE. Then we add on the company B. And here's a case, again, 100 units of sales, same gross profit, but operating expenses are higher, 50 units, because we have now 20 units of owner's compensation. So our net income is only 10 compared to A, which is 20. We add back the interest, taxes, depreciation, and amortization. We get an EBITDA of 20, which is lower than company A. However, because the additional expenses are due to owner's compensation, when we add that back, we have SDE of 40. So from a valuation perspective, both these companies have the same free cash flow to a buyer, or free cash flow that a seller has discretion over, even though they have different EBITDA. So I prefer to use EBITDA, or to prefer to use SDE over EBITDA in valuation calculations, because EBITDA is fungible. It can be manipulated. The more owner compensation, the lower the EBITDA, but the free cash flow generated by the business is the same. One owner may choose to take more comp, lowering EBITDA, while another leaves the cash in the business, raising EBITDA. But the business generates the same amount of cash from operations. You can see here the connection between the owner benefits coming right out of the operating expenses. In addition to the typical adjustments of interest expense, income taxes, depreciation, amortization, we will analyze the company's financial details to identify additional adjustments to increase cash flow. The goal is to paint the picture of the real cash flow the business is generating in the normal course of operations that a buyer can expect to receive. Owner salaries and bonuses, I just mentioned. One-time extraordinary expenses. So, for example, PPP income is a one-time event, so we don't count that in our valuation calculation as part of the cash flow. Maybe the business pays rent for at above or below fair market value because the owner of the business also owns the property and either wants, for tax purposes, to pay higher than market value rent. And as you can see on the slide, there are a number of other categories of adjustments that we are going to make to EBITDA in order to calculate seller discretionary earnings. Now that we've kind of anchored ourselves in the terminology, let me go through a few myths that I hear business owners tell me, and I'd like to kind of clear them up. So the first one we're going to talk about is that businesses can be valued by applying rules of thumb. A rule of thumb is a metric designed to broadly estimate a sale price, such as price equals 1 times sales or price equals 4 times EBITDA. Now, I will use rules of thumb as somewhat of a sanity check after valuing a business via other methods, but it really is wrong to just use a rule of thumb as the primary method of determining value. The reason is the rules of thumb assume an average company in a specific industry at an average size, but every closely held business is not really average. And I'm going to share with you some data that we subscribe to that most business owners really don't get to see. This is a chart of privately held company transactions over the last 6 years, showing the trend in EBITDA multiples. You can see that it's been heading down, although we did have a bump in the third quarter of 2022. But I expect that this is really going to come down. A couple of things to note about this. The chart shows selling prices as a multiple of EBITDA across all industries. And you can see that they stay between 3.5 times and 5.0 times EBITDA over the last 6 years. So this is the common range in which private companies sell. They've been trending downward since 2019, which is reasonable considering how many companies suffered from pandemic-driven problems. And with an economic downturn on the horizon for 2023 of some duration and depth, I mean, who really knows? But we expect something to happen that we think valuations based on EBITDA will resume their decline. This chart shows multiples of sales, while the other one showed multiples of EBITDA. So selling prices as a multiple of net sales revenue fell from 2017 to 2020, but then started to pick up again in 2021 and 2022. We saw this as really driven by private equity money and strategic buyers buying companies in specific sectors that thrived during the pandemic. It's somewhat kind of muted in this chart because this chart covers all industries and privately held companies of all different sizes. But a key point to see here is that what's the range? Well, it's really between 0.4 and 0.7. So if you have a business, that's kind of what they're selling for, between 0.4 and 0.7 of sales. Now, again, that's the rule of thumb, and we'll see soon why you really can't apply that to every single business case. This chart, also for privately held companies, shows the difference in selling prices as a multiple of EBITDA by the type of buyer and seller. The bottom blue line represents private buyers and private sellers. And you can see in there that they're in that under 5 times EBITDA range, year after year after year. Whereas the upper region of the graph shows what happens when public buyers are involved. That's the gray line, public buyers of private sellers. And the yellow line, public buyers of public sellers. So one of the key questions here is that why are public buyers and public sellers transacting at higher EBITDA multiples than private to private? And the primary reasons are access to capital and liquidity. Public buyers are more likely to have significant cash reserves, or they can efficiently raise capital. So they can acquire a business without the high cost of debt. And look right now, with prime at 7.5 and SBA fees at 2.5, you're talking about a 10%, SBA loan is very commonplace. In order to avoid that, public companies can use the cash that they've raised from investors, so they are able to finance acquisitions at a lesser cost than private company buyers can. This chart breaks down selling price over EBITDA by sector. And again, all these charts represent historical transactions that actually happened as reported by business brokers, M&A advisors, and lenders. Key point here is that different industries are valued differently by buyers. In the case of breweries, note that EBITDA multiples for manufacturing have historically been above the all-sector average. For those involved in distribution, wholesale trade has been comparable to manufacturing over the last year, but higher than manufacturing over all time periods. What's really obvious is that the financial sector and the technology sector are earning very high valuations as buyers believe that they are going to grow and increase their profits and be targets for flipping, into the future. This sort of bread and butter businesses have all been trading, in that same range as we discussed before. And again, I'm only focusing on private companies right now, which I presume most of this audience are private companies. So what does all this mean? Let's bring it down to breweries and brew pubs. Here are rules of thumb for privately held breweries and brew pubs. But these guidelines are so broad, they ignore characteristics such as revenue size, market share, profitability level. There's really little value in it to define the value of your specific business. Yet the press and your competitors, maybe even your next door neighbor, will fixate on these metrics for predicting the sales price of your business. So one of the big drawbacks of using a rule of thumb is that it ignores the value placed on the specific characteristics of your company. How do we get these rules of thumb? By summarizing data from real transactions. So here is a data source called PeerComps that in its database has 5 brewery transactions that they're using to calculate the median values, which are then reported as rules of thumb. What the calculated median does not consider that will impact a specific valuation are things like comparable size of the subject company. We know when we dig into the data that larger companies will trade at higher multiples than smaller companies. Geographic differences. Companies in the California market or New York market are going to trade differently than those in, for example, Mississippi or Alabama. There are also qualitative metrics that are important to consider, such as staff tenure, supplier diversification or concentration, that address the risk inherent in the business. And with more risk is a lower return and vice versa. So as buyers are evaluating businesses, they're going to look at risk factors such as concentration, staff tenure versus turnover. So And then also consider that in any calculation of a median, there are a spectrum of data points, both above and below the median value to get to that median. So the median doesn't necessarily reflect your business. Maybe you deserve a premium to the median. Maybe you deserve a discount. All these factors will come into play as we drive down into a specific valuation, for your business. But again, another reason why the rules of thumb can tell you historically this is the median value of transactions, but it really is an incomplete picture if you try to extrapolate those median values to your own business. So here are three of my clients: a Maryland brewery, a New Jersey brewery, and a Pennsylvania brewery. Now, New Jersey has revenue and SDE in proportions that drive similar values from both of the rules of thumb that I showed you earlier. And essentially, the rules of thumb, the calculations, should produce a similar value using each formula. But the Pennsylvania and Maryland clients are much more profitable than New Jersey, so the SDE-based rule yields higher values than the revenue-based rule. So while theoretically applying each rule would yield the same business value, they don't in these cases. So which one is relevant? Well, neither are exactly relevant, and that's part of my point. The second myth I like to talk about is that valuations use the same multiples for similar businesses. For a fair business valuation, you need a deep understanding of the business and must consider all the company's financial and technical aspects: the company's brand, expected growth rate, business model, customer base, and other business factors significantly determine business value. Since all these factors will differ for different companies, there can never be a standard multiple to assess business value. Or in other words, the broadly published values of market multiples are not applicable to each business. Let's consider an example. Burger King and McDonald's are both well-known fast food brands. You would think that they are the same. They each attract a similar customer, but this is where the resemblance ends. Each brand has an entirely different business model, which affects their valuation. McDonald's owns most of the land where its retail outlets are built, which is then leased as a long-term contract to each franchisee. On the other hand, Burger King maintains no control over individual storefront operations, so each franchisee controls the real estate. Different business models, so each store is going to be valued differently. Now, here are market multiples for lower middle market breweries and brew pubs, and I picked a size category of under 5 million net sales from a data source called DealStats. So this is part of what we call the market method of valuation, comparing the target company to historical market data. This data is a little bit better than using those rules of thumb because we can distinguish based on size. The multiples for businesses that are under 1 million are different than those in this 1 to 5 category, and those that are larger than 5 million are higher than that. So what can we draw out of this? First, the more food-centric your operation, being more of a brew pub than a production brewery, you can expect lower valuations for the same level of sales, same level of gross profit, SDE, and EBITDA. We see that across the board. Also note, these numbers are median values from analyzing many transactions. So many companies have been sold at values above and below the median. These are numbers that show an average of the past. Again, not what your specific company would be worth. But we're starting to get a little bit more distinguished now. Remember, we looked at overall market of all industries. Then we could see what manufacturing looked like. And now we're digging down and we're separating breweries and brew pubs, getting a little bit more granular. And part of this valuation difference, you might ask, well, why are production breweries valued higher than the brew pubs. Well, part of this is also a COVID effect, right? The whole restaurant industry got hammered during the pandemic, and they're not all coming back. Some are, but the production breweries who were able to brew and bottle or can and get their products into retail outlets really were able to manage during the pandemic and continue strong operations. Now, this slide applies the brewery multiples from the prior slide to my three clients. So note how the gross profit and revenue multiples are clustered together. This is not surprising because cost of goods sold as a percent of sales do not really vary that much among breweries, but profitability varies a lot. So the EBITDA and SDE multiples you can see are very, very different. For New Jersey and Maryland, the different types of multiples yield very different values. Now, which metric is most important? Because as you look at this, let's pick the Maryland brewery. By an EBITDA metric, they're only worth $500,000. By an SDE metric, they're valued at maybe $750,000. And if you go to a gross profit metric, they're valued at $3 million. So what really is their value? Well, some of that answer may depend on the buyer. An entrepreneur, known as a financial buyer, wants cash flow or SDE because they're buying a business to operate and they want profit. Oftentimes that profit is necessary to pay the debt service on a loan to buy the business. A strategic buyer, however, like a competitor, usually wants gross profit because it already has the supporting infrastructure, right? So if a competitor bought your brewery and took over your brands, they'd have additional volume to sell, but they may not need the entire infrastructure that you have. An institutional buyer, like private equity, typically favors sales metrics, since its goal is to bundle several companies together, slash expenses, and then eventually flip to another investor. So they want to build a company that has a high level of sales, and they know that they can change the profitability of the company that they acquired. So they're not so worried about the current profitability structure because they're going to improve it. Now let's display the rules of thumb perspective with the deal stats market multiples. Do revenue-based multiples match with both methods? Do SDE-based values match with both methods? No, which is why I don't use rules of thumb to quote a business value. This variety of values is why you really can't simply grab a published market multiple. Like we said before, it was 4.5 times EBITDA, or 40% of sales plus inventory. There's much more to homing in on a reliable value. So again, here, looking at the bottom left, I guess it's the gray. That's your SDE rule of thumb, and then the olive being the revenue-based rule of thumb. And then we get into the other multiples for the 5 million and under breweries. So you can see the valuations are all over the place if that's all the only tools that you rely on. Value is multifaceted and includes both tangible assets and intangible assets like brand reputation, trademarks, patents, goodwill, etc. Intangible assets give rights and privileges to the business, which means they have value too, like your intellectual property. So while assessing the business, it's necessary to estimate the value of all of its assets, both intangible and qualitative. And these are often grouped as goodwill, but each is different. The intangible assets also represent the company's secret sauce, what makes you different and special, what makes you prized by your customers. And since these assets do not have a physical form, agreeing to their value is often the most significant challenge when negotiating a purchase price. Myth number 4 I want to deal with is that valuation only looks at today's numbers. Unless you're selling your business based on its net asset value or book value, the past performance of the company as a standalone data point really has limited value. A buyer is not purchasing your company based on what it has done in the past, but on what it can do in the future. Essentially, the viability and predictability of future cash flows. This is calculated using the discounted cash flow method, where future earnings are projected and discounted back to today's present value based on the theory of the time value of money. For example, if annual inflation is 5%, 105,000 earned, it's too quick. 105,000 earned a year in the future is worth $100,000 today. So since you're selling the future earnings of the business, past performance is only meaningful because it can help predict future results if it identifies a consistent trend, a trend that's likely to repeat. So all things being equal, the more consistent your past performance, the easier it will be to predict the future of the company. And the more confidence a buyer has in the projection of future performance, the higher price he or she will pay for those anticipated future earnings. Number 5, valuation amount equals purchase price. So the purchase price is the total amount the buyer is willing to pay. The business valuation is a baseline figure. It does not guarantee the purchase price. It's actually an ingredient of the purchase price. A buyer will assess the transferable value of the business, which represents the value he or she will gain from future operations. Maybe owning the business will be worth more than just an investment. Maybe it will provide jobs for the buyer and his or her family members. Maybe the seller is so important to the business that the buyer will offer more if the seller will stay on post-sale. Plus, the deal structure will affect the final figure. There are a number of structural elements that have an impact on the transaction price, including, is it a stock sale or an asset sale? A stock sale being you're buying the business entity with its assets and liabilities versus an asset sale where you're only buying the assets. Another factor is the amount of down payment at closing versus future payments. Maybe the buyer needs seller financing to close the deal. Maybe there's working capital needs that a buyer requires. For example, I sold a business last year where the buyer wanted a minimum of $400,000 of working capital to be left in the business. So they agreed to pay for that, and they would pay extra if there was cash left in the business above that threshold, and they would deduct from their closing price if insufficient cash was in the business at the time of closing. Another important factor to consider is that if you're only selling a portion of your business, a minority or non-controlling discount may be applicable. A minority shareholder does not have the same rights as a majority shareholder regarding business operations, strategies, setting compensation, and other things. So a valuation is the valuation of the total business, but if you're going to sell a minority portion, we would apply a discount, so the transaction price is not going to be an exact pro rata amount of the valuation. Number 6, all value is relative. Now, when asked how much something is worth, many people will say that the fair market value is whatever someone will pay for it. Even though there's no precise value for a given business interest, we do not subscribe to the premise that, as in the case of a work of art, that value is completely subjective. Companies do have an intrinsic value based on the future economic benefits that they can provide to the buyer. And the last myth I want to talk about is that all businesses are saleable. There are some businesses that are not saleable simply because they're less expensive to start from scratch. In these cases, there's no real benefit to acquiring an existing company. And there are other businesses that operate for a long time without ever paying the owner a return on his or her investment. Sure, the company has hopefully paid the owner a salary, but unless that salary and other benefits exceed the market value salary for what the owner is doing on a day-to-day basis, the owner may only have a job, not a business. If you own a business and work in it, you're entitled to both a reasonable salary for the work you perform as an employee and a reasonable return on your investment as an owner. For these reasons, believe it or not, fewer than 30% of businesses offered for sale actually sell. Okay, the next part of what we're going to talk about are some valuation methodologies that are commonly used in the science of performing business valuations. This chart lists 8 different valuation methods. There are 3 main categories. So the income approach is really independent of the market multiples that we've been talking about. It's directly related to the present value of the future cash flows. Now, it requires estimates of future cash flows. And of course, that's really conjecture. So there's a risk to this, and we have to deal with that in our calculation. The buyer's test method is something you may not have heard of. And what we do here is we calculate the price at which a buyer receives a target compensation plus desired investment return after paying their debt service. So while most valuation, I'll say, is sort of a bottom-up process, the buyer's test is a top-down method to come up to that price where the buyer feels he or she can pay for that business. The market approach we've talked about in terms of the comparable transactions, where we've looked at historical transactions to see what they have been, what they closed at, what multiples of EBITDA and SDE and revenue and gross profit. The comparable companies method is where we use guideline public companies because the shareholders are actively communicating the value of the business every day when shares are being traded. So at the end of the market day, we know the value of that business as a multiple of their reported sales and of their reported EBITDA. The asset approach focuses on the value of the company's assets. It does not take into account goodwill, and it does not care about the market multiples and does not care about the income. So it's primarily used in liquidation situations or maybe selling equipment only, but not selling the intellectual property and brands. In fact, I'm in the middle of a deal right now where we have one letter of intent to buy the brewery's equipment, and the buyer is going to use that equipment for expansion. And we have another buyer who's buying the intellectual property, the brands, the distribution network, to add to the portfolio of products in his brewery. So different methods fit different situations. Now let's talk a bit about the valuation process, and then I'll close up. What's involved first is analyzing the financial statements of the business for sale, and we make the adjustments that we talked about previously. Next, we interview the client to learn the qualitative factors that are going to influence the value. In other words, we know some of the mean values historically, but we want to find out the factors that would move them toward a premium or toward a discount. We'll do market research on the public companies that may present us with comparable data. We'll also go through which of those methodologies are most appropriate that I talked about before, emphasizing the asset, the income, or the market method. Then we'll consider qualitative adjustments. How will these factors positively or negatively impact the value of the company? And lastly, put all the puzzle pieces together to arrive at a valuation conclusion. This slide just shows some of the qualitative factors that we'll use in valuing a business in order to come up with a premium or discount adjustment to the reported values that we get from our data sources. And the last part of it, so as it comes together, in summary, we take the precedent transactions, we look at our comparable companies, we'll look at the income method for discounted cash flow, because really the future cash flows is what we're focusing on. And we'll look at the qualitative factor. And that will all result into what we call the football field. And here you can see a graphical depiction of the high, low, median values using different valuation methodologies. And on the far right, the implied valuation based on our decision on how to weight each of the other valuation methodologies. For example, in this case, the public company method was weighted very low, and the adjusted market method, where we use qualitative factors, was deemed to be most important and was weighted very high. So, which company is worth more? Here's two examples. A and B are both 5 years old, 10 million revenue, but B is a little bit more profitable with a 20% margin. B has a strategic owner. That's a good thing. But A has 2 locations. That can reduce risk. A has diverse customers and B is highly concentrated. B has high staff turnover. A has long tenured staff. So as you can see, as you look at all these factors, just because one is more profitable than the other doesn't mean that that business is going to be more highly valued. Essentially, we see valuation as much art as science. And I hope you've learned a bit from this. And I'll take a look at the Q&A in the chat and see if there's anything that I need to kind of follow up on. And I don't have any questions at all. So I want to thank you for listening in. If you're here live, and if not, I hope you're enjoying the playback post presentation. Thanks very much.